everyone. Today, let's look at how markets are reacting as central banks are starting to withdraw liquidity. The rout in bond markets was already tough, but both the ECB's clear hawkish stance and the acceleration of US inflation to 8.6% in May have accentuated the fall. The Bloomberg Global Aggregate Index, which is made of investment-grade sovereign and corporate bonds, has fallen by 15.6% this year. The loss as of June 14 is close to 10 trillion of US dollars. So the phrase nowhere to hide is ringing around every corner in the market. Of course, we all knew that sooner or later we would have to break the addiction to easy money, but the road to withdrawal proves more agonizing than we had imagined. This is the case in Europe, where the ECB has hardened the tone, which provoked a very bearish reaction of the bond markets. And this shows the level of anxiety. Above all, it underlines the fear inspired by the unequal consequences of an aggressive monetary tightening on 19 different countries. In other words, while the ECB's restrictive turn could have a brutal impact on Italy, a country especially vulnerable to rising rates, the situation would be much less worrying for, let's say, Germany. This fear, of course, also applies to the debts of other peripheral countries. This is why, as the assumption of a rise in European rates became clearer, the gap between the borrowing costs of Germany and the peripheral countries widened. The ECB then considered it essential to provide a rapid response to investors who doubted its ability to fight inflation while avoiding a too large spread in yields between the countries of the North and the South in Europe. The risk is that a fragmentation of financing conditions in the Eurozone could make the cost of debt unbearable for some countries or even deprive them of access to the markets. Thus, on June 15, barely 6 days after announcing a rate hike in July, the ECB reacted by convening an exceptional meeting during which it said it wanted to reinvest the maturities of the PEPP portfolio in a flexible manner. In addition, a new tool was implemented to prevent the fragmentation of the euro area by supporting the most indebted member countries. These measures all aim to preserve the functioning of the monetary policy transmission mechanism. Although no formal tool were unveiled, investors were reassured about the sustainability of peripheral debt. Sovereign 10-year yields fell by 36 basis points in Italy, 46 in Greece, 26 in Portugal, and 23 in Spain, compared to only 11 in Germany. However, a gray area remains, with some experts noting that the more or less rapid development of an anti-fragmentation tool could pave the way for an even more rapid rate hike cycle. A reminder that the weaning of easy money is only just the beginning. Thank you.